You know, when you think about building real, lasting wealth, it can sometimes feel a bit like chasing a moving target.
Hmm, definitely.
But the core of it, for most of us anyway, comes down to making smart investment decisions and sticking with them for the long haul.
Absolutely. Long term is the key phrase there.
So today, we're doing a deep dive into what history can actually teach us about this.
Mm-hmm.
We're looking specifically at long-term investment performance across, well, different kinds of assets.
Right. And our main source for this is the April 2025 edition of FundsIndia's Wealth Conversations. It's a really useful resource.
Yeah, I found it really insightful.
Exactly. This isn't about, getting rich quick or chasing the latest fad. The Wealth Conversations report gives us a solid foundation by looking at the actual track record of different investments over pretty significant periods.
And it covers a lot of ground, doesn't it?
It really does. Equity, both India and the U.S., debt, gold, even real estate and currencies, and crucially, how these all connect to things like inflation, asset allocation, and diversification in your overall plan.
Right. So, for everyone listening, our goal today is basically to cut through all that noise and pull out the most vital insights.
Yeah, the actionable stuff.
Exactly. We want to help you become a more confident, more informed investor, someone who gets the long-term picture, sets, realistic expectations for growth, and hopefully avoids some of those behavioral traps, those emotional pitfalls that can really mess up even a good investment plan.
That's the hope, definitely. Managing behavior is half the battle.
So to get us started, what's the most fundamental picture? Where should we begin?
I think the best place to start is just looking at the long-term returns. How have the major asset classes actually performed? The Wealth Conversations report has these compounded annualized returns as of March 31st, 2025. And it looks back over different time spans, 1 year, 3 years, 5, 10, 15, even 20 years.
Right, gives a really broad perspective then.
Exactly.
Okay, so let's unpack that. When you look at that really long view, the 20-year one, what are the key trends? What jumps out?
Well, the real standout performer over that whole 2-decade period has clearly been Indian equities.
Okay, represented by what?
Represented by the Nifty 50 TRI, the Total Return Index. It delivered an impressive compounded annual return of around 14.4%.
14.4% per year for 20 years.
Yeah.
Wow.
And what that actually means, in practical terms, is if you'd invested in the Nifty 50 index 20 years ago, your money would have multiplied nearly 15 times by March this year.
15 times. That really puts the potential of, well, long-term equity investing into perspective, doesn't it?
It certainly does.
How did other common investments stack up over that same 20 years, like U.S. stocks or gold?
Good question. U.S. equities, if we use the S&P 500 Total Return Index but translated into Indian rupees, also did very well, delivered around 14% annualized.
So pretty similar to Indian equities then.
Very similar over that specific 20-year period, yeah.
Right.
It resulted in about a 13.7 times increase. Gold, looked at in INR, was also surprisingly strong over this time frame, roughly 14.2% annually, multiplying about 14.3 times.
Huh, interesting about gold. What about things like real estate or debt?
Well, they definitely gave positive returns, but they lagged behind quite a bit over those 2 decades. Real estate showed an annualized return of about 8.7%,
Okay.
which meant your money multiplied about 5.3 times. And debt came in at about 7.5% annually, multiplying your initial investment about 4.3 times.
Right, so it really sounds like the core message right off the bat is for that really long-term wealth building, equities, both Indian and U.S. in this case, have generally been the main engine driving the highest returns.
Precisely. As the report highlights, when you take that really long view, equities have tended to outperform the other major asset classes. It's a crucial point to keep in mind when you're thinking about your own long-term strategy.
Okay. Now, let's zoom in a bit more on Indian equities specifically. The report talks about the Nifty 50's long-term growth story going way back to July 1990. What's the big picture takeaway from looking at such a long history?
Well, what's truly remarkable, I think, is just the sheer scale of the wealth creation that's happened. Since July 1990 up until March 2025, so over 34 years, Indian equities delivered a compounded annual growth rate, or CAGR, of approximately 13.6%.
Okay. And what does that translate to in terms of multiplication?
That translates to your money multiplying an astonishing 84 times.
84 times. Wow. That's a number that really sticks with you.
It really underscores the immense potential, of investing in a growing economy over the very, very long term.
Yeah. Now, the report also breaks these returns down by company size, right? Large cap, mid cap, small cap, flexi cap, too. Were there big differences in how these different parts of the market performed?
Absolutely. And this is quite interesting. If we look at the last 15 years specifically, say up to March 2025, both the mid-cap and small-cap segments have shown particularly strong performance.
Okay.
The indices they track, like BSE Mid-Cap TRI or Nifty Mid-Cap 150 TRI for mid-sized companies, and the small-cap ones like BSE Small-Cap TRI or Nifty Small-Cap 250 TRI, they've delivered returns somewhere in the range of 13% to 16% per year.
So even higher than the overall Nifty 50 in that period.
In that 15-year period, yes. It suggests that while the bigger, more established companies provided solid growth, these mid and small cap sectors offered, well, significant opportunities too.
And it's interesting, looking at the data, even within the large cap space, different indices like the Sensex TRI, Nifty 50 TRI, Nifty 100 TRI, they all show pretty consistent long-term returns, somewhere in that 11–12% annualized range over the past 15 years.
Exactly. They track slightly different baskets, but the long-term trend is similar. And the flexi-cap category, like the Nifty 500 TRI, which can invest across all sizes, that also shows similar long-term performance.
Right.
But the report also makes a really important point about actively managed mutual funds.
Ah, yes, I saw that. It says many well-managed funds have actually beaten the index over the long run.
That's right. It highlights several examples. In large caps, funds like Franklin India Blue Chip or HDFC Large Cap have shown returns, in that 11–12% range annually over 15 years, sometimes even a bit better than the Nifty 50 TRI itself. Moving to mid-caps, funds like Franklin India Prima Fund or Nippon India Growth Fund, they've delivered even more impressive returns over that same period, closer to that 15–16% mark we mentioned for the mid-cap indices.
Wow.
And in the flexi-cap space, funds like Aditya Birla Sun Life FlexiCap, Franklin India FlexiCap, HDFC FlexiCap, they've also shown strong long-term performance, often beating the broader Nifty 500 TRI.
So it really emphasizes that just buying the index is one way, but careful fund selection could potentially boost your outcomes.
It certainly suggests that possibility, yeah. While understanding the broad market trends is crucial, the specific investment choices you make within those markets also clearly matter.
Okay. Now, shifting focus slightly, the report also looked at U.S. equities. What were the main highlights there? We touched on the S&P 500.
Right. Looking at U.S. equities in Indian rupee terms again, the NASDAQ 100 index really stands out.
Ah, the tech-heavy one.
Exactly. It delivered around 18.6% compounded annual returns over the last 20 years.
18.6%.
Yeah, which resulted in an initial investment growing roughly 30.5 times.
Huge returns.
Huge. The S&P 500, as we said, also showed strong performance in INR terms. And the report also mentions the MSCI World, which represents developed markets globally, and the MSCI Emerging Markets Index. They also provided positive returns, though generally a bit lower than the NASDAQ 100 and S&P 500 over the periods shown.
Okay, so the takeaway is that both Indian and U.S. equity markets have offered pretty compelling long-term growth opportunities for investors, though maybe with different flavors.
That seems fair to say, yes.
So we've seen this impressive long-term growth potential, both Indian U.S. equities, but I think what often holds people back, what makes them hesitant, is the volatility, right? The ups and downs.
Absolutely. Fear of losing money is a powerful emotion.
And the report tackles this directly. It looks at the probability of actually seeing negative returns in Indian equities over different timeframes. What did that analysis show?
This is really, really vital for managing expectations as an investor. If you look at very short periods, like a single day or even a month, the chance of seeing a negative return in the Indian market using the Nifty 50 TRI is, well, naturally higher. It's noisy day to day.
Sure, makes sense.
But, and this is the crucial part, as you extend the time you stay invested, that probability drops significantly.
Okay.
For instance, while you might see down days or months fairly often, if you look at a 3-year investment period, the instances of ending with less than you started become much less common. And when you stretch it out to a 10-year period, historically speaking, the occurrence of negative returns has been quite rare, almost negligible based on this data.
Right. So time really acts as a buffer against those short-term market swings.
That's a great way to put it, yes.
It really underscores that idea that for equity investing, a longer time horizon isn't just like helpful, it's almost essential for riding out the inevitable bumps.
Couldn't agree more.
And the report also looked at the flip side, the increasing chance of getting higher returns, right? specifically returns over 7% and over 10% with longer holding periods. What were those findings?
Yeah, and here's where it gets really encouraging for long-term investors. The data clearly shows that the longer you stay invested in Indian equities, again using the Nifty 50 TRI, the higher the probability of achieving those more substantial returns.
Okay, like how high?
Well, for example, over a 7-year investment period, the report shows that historically, Indian equities delivered returns greater than 10%. Wait for it. About 84% of the time.
84%, that's a very high likelihood.
It is. And perhaps even more reassuring for people worried about losses, over any 7-year holding period they looked at, there wasn't a single instance of a negative return.
No negative returns at all over 7 years.
Not in the historical data they analyzed, no. The lowest return observed was around 5%. So even the worst 7-year period still gave you a positive, albeit modest, return.
That really emphasizes the potential rewards of just being patient, doesn't it? Sticking with it.
Patience and time, absolutely key.
Okay. Now, the report then dives into something called rolling returns for the Nifty 50 TRI. Looking at all possible holding periods, 1 year, 2 years, up to 15 years, starting from June 1999. For listeners, what can we learn from looking at rolling returns like this? Why is it useful?
Rolling returns are great because they give a much more, let's say, stable and realistic picture of performance than just looking at one fixed start and end date.
How so?
Instead of just saying, what was the return from 2005 to 2015? Rolling returns show you the annualized return for every possible 10-year period within the overall time frame. So Jan 99 to Jan 08, Feb 99 to Jan 09, and so on.
Ah, I see. So it captures performance across lots of different market cycles.
Exactly. By looking at the average rolling return, the maximum return achieved in any of those periods, the minimum return, and also how often the returns fell into different buckets, like below 0, below 7%, above 10%, we get a much better feel for the range of outcomes you might have experienced.
Got it. And were there any particularly striking stats from that rolling return analysis?
Yeah, one that really stood out to me was that historically, Indian equities have tripled in value. So a 3x return within a 10 to 11-year time frame, approximately 80% of the time.
Wow, tripling your money in about a decade, 80% of the time. That really shows the power of compounding when you hold on.
It does indeed.
And so, based on all this, the probability analysis, the rolling returns, the report basically concludes that investing in Indian equities with a time frame of 7 years or more has generally led to a pretty good, rewarding experience for investors.
That's the gist of it, yes.
Yeah.
While short-term volatility is definitely part of the deal with equities, having that longer investment horizon significantly improves your odds of actually reaching your financial goals.
Makes sense. Now, the report also touches on different ways you might actually invest, right?
Yeah.
Specifically comparing putting in a large sum all at once, a lump sum, versus spreading it out over time using something called systematic transfer plans, or STPs.
Right.
What were the key insights on those approaches? Is one better than the other?
Well, the report acknowledges that for many people, especially when markets feel a bit choppy or uncertain, the idea of investing a large lump sum amount into equities all at once can be, well, psychologically difficult. It feels risky.
Yeah, I can definitely relate to that feeling. What if I invest right before a crash?
Exactly that fear. So the report shows year-wise lump sum returns for the Nifty 50 TRI and also for those FlexiCap funds we mentioned earlier, HDFC FlexiCap and Franklin India FlexiCap. And what it shows is that, on average, even if you invested a lump sum at various points in time over the years, your money still would have more than doubled over a 7-year holding period.
So even lump sum investing has worked out well over the long term, on average.
On average, yes. But to help with that hesitation, that fear of timing it wrong, the report discusses using STPs.
Okay, remind us how an STP works.
An STP, or systematic transfer plan, involves putting your lump sum into a lower risk fund first, usually a debt fund or liquid fund. Then you set up instructions to automatically transfer a fixed amount from that debt fund into your chosen equity fund at regular intervals, say weekly or monthly over a set period. In the report's example, they used 6 months.
Ah, okay, so you're gradually moving the money into equities over time.
Precisely. The report provides year-wise returns for doing a 6-month STP into the same indices and funds. The idea is that this can be a less nerve-wracking way to deploy a larger amount, potentially smoothing out the entry price and reducing the risk of investing everything at a market peak.
So it's a bit like dollar cost averaging, but you're starting with the full amount parked somewhere safer first.
That's a good way to think about it, yes.
And speaking of regular disciplined investing, The report obviously also covers systematic investment plans, SIPs, investing a fixed amount regularly, typically monthly. What did the historical performance of equity SIPs look like over those longer 7+ year periods?
Yeah, the SIP data really strongly reinforces the positive experience we've been talking about with long-term equity investing.
Good returns there, too.
Very much so. By looking at year-wise SIP returns for the Nifty 50 TRI, and again for HDFC FlexiCap and Franklin India FlexiCap, the report shows that consistently investing a fixed sum regularly over 7 years or more has historically been a very effective strategy. It often led to those attractive returns, frequently above the 10% mark.
So it highlights the benefit of discipline, consistency, just automating it.
Exactly. Taking the timing decision out of it and just investing regularly, regardless of market noise.
Okay. So whether you go lump sum, maybe using a STP to ease in or take the gradual SIP route, the fundamental message about the long-term wealth-building power of equities seems pretty consistent.
It does seem that way based on this historical data.
No, it's important, of course, to remember your investments don't exist in a vacuum. The report also provides that crucial comparison. How have equities performed against other key things, like inflation, debt, gold, real estate?
Right, context is everything.
What were the key takeaways from those comparisons? How did equity stack up?
This is where you really see the potential of equities as that long-term growth engine. The report clearly shows that, historically, Indian equities Nifty 50 TRI, again, have significantly beaten inflation over the long run.
By how much?
By an average of around 7% to 9% per year above inflation. That's real growth in your purchasing power.
That's substantial. What about versus debt?
The outperformance against traditional debt investments like fixed deposits or debt funds has been even more significant, somewhere in the range of 6% to 8% per year, on average, over the long term.
Okay. And gold, often seen as a safe haven.
Even compared to gold, equities have delivered higher returns over the longer 15-20-year periods looked at in the report, by about 2–3% per year on average.
Interesting. And real estate?
Compared to real estate, the outperformance of equities has been in the vicinity of 5–6% per year, according to the data presented.
Wow. So these are pretty big differences when you compound them over many, many years.
Absolutely.
Yeah.
It really highlights the potential, the risk of your purchasing power being eroded if your investments don't at least keep pace with inflation. And it shows the potentially lower growth you might expect from more conservative assets compared to equities, again, over that long term.
And there's always a but with equities. With those higher potential returns comes the reality of volatility.
Right.
Market ups and downs, temporary declines, drawdowns, as they're called.
Yes, the price of admission, some say.
The report tackles this head-on, doesn't it? What does it say about how often we should expect these dips?
It does, and this is so critical for investors to understand and, frankly, accept as just a normal part of the journey. The report states quite clearly that market falls in the 10% to 20% range are actually pretty common.
How common?
Happening almost every year.
Every year, wow.
Yeah, when they analyzed the Sensex year-wise drawdown data, going way back to 1980, they found that in a remarkable 89% of those years, the market experienced at least a 10% decline from its peak at some point within that year.
89%. That really highlights that volatility isn't some rare event, it's just inherent in the market.
Exactly. It's a feature, not a bug, you could say.
That's a stark reminder, then, that these temporary dips shouldn't be a cause for panic, more like a regular feature of the landscape.
Precisely. But the crucial point that follows is that despite these frequent intra-year declines, a big majority, 36 out of the 45 years they analyzed, still ended with positive overall returns for the Sensex for the calendar year.
So even in years with a 10% or 20% dip, the market often finished higher by year-end.
Often, yes. It reinforces the idea that while these drops feel unsettling, they don't necessarily derail the long-term upward trend.
Okay, what about bigger falls, the really scary ones?
The report also looks at those more significant market falls drawdowns greater than 30%. It notes that historically the recoveries from such sharp declines have typically taken around 1 to 3 years.
1 to 3 years to get back to the previous peak.
Roughly, yes. And in the large cap segment of the market, these kinds of substantial temporary falls, 30% plus, have historically occurred about once every 7 to 10 years.
Okay, so less frequent, but definitely something to be mentally prepared for over a long investing lifetime.
Exactly. Plan for it, expect it at some point.
So while these larger downturns are more concerning, history suggests they've also been followed by recovery periods. Now, did the report look at how these drawdowns differ across market caps? like comparing large caps Sensex with mid and small caps.
Yes, it did. Comparing the Sensex with the Nifty Mid-Cap 100 and Nifty Small-Cap 100 since 2004. And this is an important consideration if you're investing beyond just large caps.
What did it find? More volatility in mid and small.
Generally, yes. The data indicates that mid and small cap companies tend to experience both more frequent and larger temporary declines compared to large caps.
Okay.
For example, looking at year-wise drawdowns for the Nifty Mid-Cap 100 and Nifty Small-Cap 100,
Yep.
the magnitude of the falls in bad years and the frequency of significant dips were generally higher than for the Sensex.
So bigger swings, basically.
Bigger swings, yes. Falls of more than 30% seem to have occurred with similar frequency, maybe once every 8-10 years. But the depth of those falls could potentially be greater in mid and small caps.
Right. But did they still tend to recover and deliver positive returns over time?
Yes, importantly, just like with large caps, the report points out that a majority of calendar years for both mid and small caps still ended with positive returns, even after experiencing those larger intra-year drawdowns.
Okay. So it sounds like the potential for maybe higher returns in mid and small caps comes with that trade-off.
Yeah.
You need to be prepared for a bit more of a roller coaster ride along the way.
That seems to be the historical pattern, yes.
Yeah.
Higher potential reward often comes with higher volatility.
Now, all this talk about market declines inevitably brings up that big question. Should I try to time the market? Sell before a crash, buy at the bottom?
The million-dollar question.
The report offers its perspective on time in the market versus timing the market. What's the core message for us there?
The report comes down pretty strongly on the side of time in the market. It emphasizes the crucial importance of staying consistently invested through thick and thin, through various market cycles and crises.
How does it illustrate that?
Well, it highlights the impressive long-term growth of the Sensex, say from 1986 to 2025, almost 4 decades. Despite navigating numerous major market shocks, the dot-com bubble, the 2008 global financial crisis, COVID-19 more recently, the key takeaway is that every single one of those past crises was eventually followed by a recovery and then further upside. The market found its footing and moved higher again.
It's a powerful visual, isn't it? Imagining that long upward climb with all those jagged dips along the way.
It really is. And even within long bull markets, the report shows examples of multiple temporary corrections, like 10-20% drops happening along the way. But the overall long-term trend remained up.
And the report even tackles that specific fear we mentioned. What if I invest a big chunk right before a major crash?
Yes, it does. They looked at the annualized returns of the Nifty 50 TRI, starting from the peak just before several major market crises since the year 2000, and calculated the return up to March 2025.
And what did they find? Was it disastrous?
Surprisingly, no. Even in those, let's call them worst-case timing scenarios, where someone invested right at the top before a big fall, the long-term returns achieved over the subsequent years still turned out to be quite decent, respectable.
Really? Even after starting with a big immediate loss?
Yes. It really underscores the market's resilience over the long haul and the power of recovery and continued growth. It suggests that even terrible timing might not ruin your long-term results if you just stay invested.
That's quite comforting, actually. And then there's that other crucial point about trying to time the market, the risk of missing the best days.
Ah, yes. This is a killer argument against market timing.
What did the report find there?
The analysis showed that if you had missed just the 10 best performing days in the market over the last 20 years, your final portfolio value could have ended up being a staggering 50% lower.
50% lower just for missing 10 days out of 20 years.
Exactly. Half your potential wealth gone. And here's the kicker. Many of these best days tend to happen during or very shortly after periods of major market panic and crashes, often very close to the worst days.
So they cluster together when volatility is high.
Precisely. Which makes it almost impossible to reliably jump out before the bad days and jump back in just before the good days. The cost of being out of the market at the wrong time is huge.
Yeah, that sounds like a losing game. Trying to perfectly time those swings seems incredibly difficult, if not impossible.
The data certainly suggests it's very, very difficult.
The report also touches on something else that makes investors nervous: all-time market highs. People see the market at peak and think, surely it must fall now.
It's a very common feeling, yeah. Fear of heights.
What perspective does the report offer on investing at all-time highs? Is it actually a bad time to invest?
The report makes a great point. Reaching new all-time highs is actually a natural characteristic of a growing asset class like equities. If the economy is growing, companies are growing profits, the market should be hitting new highs over time.
Right. It's a sign of success, not necessarily impending doom.
Exactly. It shouldn't automatically be seen as a signal to sell or panic. In fact, they analyzed the Nifty 50 TRI's performance after it reached all-time highs between 2000 and 2025.
And what happened? Did it usually fall?
Actually, the average one-year return following an all-time high was quite healthy, around 14%.
14% after hitting a high.
On average, yes.
Huh.
And there was a high percentage of positive returns over 1, 3, and 5-year periods starting from those peaks.
Huh.
And get this, in nearly half of the instances when the Sensex reached an all-time high, it didn't even subsequently drop by 10% from that high.
So much for the what goes up must come down immediately idea.
It certainly challenges that common assumption. A market at a high doesn't mean a crash is guaranteed, or even likely in the short term.
Okay. And finally, on this theme of market timing, the report looked at strategies like trying to book profits when the market hits a high compared to just buying and holding.
Right, comparing active timing versus passive holding.
What did that analysis find? Does trying to sell high and buy back lower work better?
The data presented in the report clearly favors just staying invested for the long term. They looked at the annualized performance difference between a simple buy and hold strategy and various profit booking rules like selling when your gains hit 20% or 30% or 50% or just selling at all-time highs. And over 10-year periods, the buy and hold strategy consistently outperformed those more active trading or profit booking approaches.
So fiddling with it, trying to be clever, actually led to worse results than just holding on.
That's what this specific analysis suggests, yes. It strongly reinforces the idea that for long-term investing, patience and staying the course, even through those highs, tend to be more rewarding than trying to perfectly time the market's peaks and troughs.
Okay, so let's try and pull all of this together then. When it comes to investing in Indian equities for the long term, based on this FundsIndia's Wealth Conversations report, what are the absolute key takeaways, the main messages?
I think the report summarizes it quite well. There may be 4 key things to remember.
Okay.
First, over the long haul, think 10, 15 years or more, equities in India have historically delivered returns significantly above inflation. So real wealth growth.
Right. Beating inflation is crucial. What's second?
Second, based on that history, a reasonable expectation for long-term returns from Indian equities might be somewhere in the range of inflation, plus maybe 4% to 6% extra per year.
Okay. Setting a realistic target. Got it.
Third, and this is critical for managing your emotions, you have to be prepared for the shorter-term realities. Market declines of 10% to 20% happen almost every year. They are normal.
Expect the dips. Don't be surprised.
Exactly. And fourth, those more substantial drops, the 30% to 60% falls, while less frequent, should also be anticipated. Historically, they've happened roughly every 7 to 10 years.
Okay. So expect the big falls too. Maybe once a decade or so.
Right. Understanding these historical patterns, the potential returns, and the expected volatility can really help you stay disciplined, stay invested, and avoid making costly emotional decisions when the market inevitably gets choppy.
Absolutely. Knowing that these kinds of swings are just part of the normal cycle can make them feel much less scary when they actually happen. You're prepared for them.
That's the idea. Forewarned is forearmed.
Now, the report also dedicated a good chunk to understanding the power of compounding, which is really the magic ingredient in long-term wealth building, isn't it?
Oh, it absolutely is. It's the engine that drives that long-term growth we've been talking about. And the report uses some really effective visuals to explain it.
Yeah, I liked those. How did they illustrate it?
Well, they contrast how we often intuitively think about growth like in a straight line, adding the same amount each year, which is linear growth,
Right.
with the reality of compounding, where your returns start earning their own returns. It creates this exponential growth curve that really picks up speed over longer periods. They use a simple example, investing €100 at 10% annual growth over 25 years. The difference between simple growth and compound growth is just massive.
Yeah, that image of the investment growth looking like a hockey stick really drives home how compounding accelerates over time.
It does. And the report also really hammers home the incredible impact of starting early.
Right, the cost of delay.
Exactly. It uses an example investing 1 lakh at 12% annual return. It shows the final amount you'd have at age 60 if you started at 20 versus starting at 30 versus starting at 40. The difference is just huge.
Eye-opening, really. Delaying by just 10 or 20 years means you end up with drastically less money.
Drastically. To make the same point differently, they also show the estimated monthly SIP amount you'd need to invest to reach a big target, like 10 crore, by age 60.
And I assume the later you start, the bigger that monthly amount needs to be?
Much, much bigger. It really highlights the significant cost of procrastination when it comes to investing.
Yeah. And I particularly liked how the report described compounding. It said it happens slowly and then suddenly.
Yes, that's a great phrase for it.
It showed visually how in the early years, most of your portfolio growth comes from your own contributions, your savings.
Right, the blue part of the bar chart.
Yeah. But as time goes on and your investment pot grows, the returns generated on your accumulated returns, the compounding effect becomes the bigger and bigger driver of growth. It starts to take over.
Exactly. They showed this with different LSIP amounts and also, crucially, by showing the impact of increasing your SIP amount by just a small percentage each year, say 5% or 10%. That accelerates things even more.
That's such a key insight, especially for people just starting out. It can feel like slow progress initially.
It really can. You put money in, the market wobbles, it doesn't feel like much is happening. But you have to trust the process. As your principal grows and compounding really kicks in, the growth starts to accelerate noticeably.
Patience again.
Patience again. The report also mentions something called the 732 rule as a simple way to remember compounding's power, though it doesn't actually detail what the rule is in the source material. Might be a fun thing for listeners to look up.
Okay. A little homework for the listeners. And the report also includes some very practical tables, doesn't it? Showing estimated times to reach different goals.
Yes, very useful. Tables showing roughly how long it might take to reach various targets, 10 lakhs, 1 crore, 10 crores, with different monthly SIP amounts, and factoring in those annual increases too.
Assuming a certain return, like 12% CAGR.
Right, assuming a 12% return, it also shows how long it might take just to double your initial investment at different rates of return. And another table shows how many times your money could potentially multiply over different periods, 2 years, 5 years, 10, up to 30 years, at various return rates from 5% to 25%.
So really tangible tools for people to get a sense of the possibilities based on their own savings and goals.
Absolutely. They can be really valuable for setting realistic financial milestones and just understanding the long-term impact of saving and investing consistently.
And it wraps up that section by just reiterating the magic of long-term investing and also mentioning the impact of higher savings rates on reaching your goals faster, especially relative to your expenses.
Yeah, save more, invest early, stay invested, let compounding work. That's the core recipe.
So as we wrap up this deep dive into long-term investment insights from FundsIndia's wealth conversations, I mean, the overarching message that really comes through loud and clear is, well, despite the inevitable ups and downs, the volatility, historically, keeping a disciplined long-term perspective on equity investing has been a remarkably rewarding strategy for building serious wealth over time.
Precisely. It's about understanding the history, understanding the potential returns, but also understanding and accepting the risks, the volatility, the drawdowns, and crucially, understanding that amazing power of compounding. If you can grasp those things, you're much better equipped to navigate the markets effectively, stay the course, and actually work towards your long-term financial goals.
So maybe a final thought for our listeners. As you reflect on your own financial journey, your own long-term goals, what key insight from everything we've explored today resonated most strongly with you?
That's a good question to ponder.
Yeah, it's worth taking a moment, perhaps, to consider how these historical trends, these principles of time, compounding, and managing volatility might inform your own investment strategy going forward.